India claims it is the world's fastest growing major economy, a manufacturing alternative to China, a rising global power ready to lead Asia. But markets do not respond to claims. Markets respond to confidence. And in 2025, the market verdict on India is visible in just one place: its currency. I'm Furqan, and this is The Pivot. Tonight, we will examine why India's growth story is hitting a wall, why the Indian rupee is Asia's worst performing currency, and what it means for the market and the Indian consumer. Over the past year, the Indian rupee has steadily weakened. Today, it stands as the worst performing currency in Asia. This is not political commentary. This is economic reality. Let's begin with the facts. At the start of 2025, the Indian rupee was trading around the mid-85 level against a US dollar. 1 year later, it is hovering close to 90 rupees per dollar. This is a depreciation of nearly 6% in just 1 year. In currency markets, this is not a small move. It is a clear signal of economic underperformance. In currency markets, this is not a small move. It is a clear signal of economic underperformance. Among all major Asian currencies in 2025, the Indian rupees has performed the worst. Even economies facing political stress or external shocks have seen stronger currency performance than India. As the rupee continued to slide, both the Indian government and the Reserve Bank of India stepped in. The central bank sold US dollar through state-owned banks. To support demand of the rupee, the government signaled confidence, played down the fall, and projected stability. But despite these efforts, the rupee kept weakening. Why did the intervention fail? Because policy signals cannot override fundamentals. Dollar selling can slow a fall, it cannot reverse it, especially when capital is leaving and external pressure is rising. Markets saw through the messaging. They saw widening trade gaps, unresolved external risks, and uncertainty with major economic partners. That is why, even with an intervention, the rupee failed to show any meaningful recovery. So, why the rupee weakening despite India's big economic claims? First, capital outflows. In 2025, foreign investors pulled nearly $18 billion. $18 billion out of Indian markets. That money moved toward Eastern Asian economies such as Taiwan and South Korea. When investors exit, they sell rupee and buy dollars. The pressure built fast. Second, trade vulnerability. India's trade deficit remains wide. In October alone, the gap stood nearly $41 billion. From April to December 2025, India's trade deficit totaled around $248 billion. A country that constantly imports far more than its exports remains exposed in currency markets. Third, the collapse of the India-US trade deal timeline. US Trade Minister recently stated that India has missed the opportunity for a deal. That single statement shifted markets' expectations. What was on uncertainty has turned into delay. And delay means risk. For a country where nearly 1/4 of exports depends on the US market, that risk directly hits that currency. India's government highlights strong GDP numbers. Yes, headline growth remains impressive. Domestic consumption is holding up. Equity markets have touched record highs, but currencies do not trade on headlines. They trade on sustainability. If growth were as resilient as projected, the rupee should be strengthening, especially in a year when the US dollar itself was weakened globally. Instead, the Indian rupee has moved in the opposite direction. India wants to be seen as Asia's next economic leader. But leadership is not declared, it is demonstrated. Reflected in investors' confidence, reflected in trade balance, and reflected clearly in the currency. As Ghalib said, दिल के बहलाने को गालिब ये ख्याल अच्छा है. In 2025, the Indian rupee sent a clear message. The story being told abroad and the reality being priced by markets are not the same. And when markets speak, they take the lead. This is The Pivot. I'm Ali Furqan.